Amazing. All right. Welcome to Griffin Uncut. This is the podcast where we talk with founders and operators throughout fintech and the tech ecosystem who are building fun and cool products about what that is like, the good and the bad, in as uncensored a manner as possible, while also trying to keep the amount of times that I have to put coins in a swear jar to an absolute minimum. Today on the podcast, we're joined by Matt Ford, who is the founder and CEO of Sidekick Money, a new wealth app that we are thrilled to be working with. Matt, why don't we start with a little bit of an introduction to you, and maybe take us back kind of all the way to the very beginning. Why did you choose to start Sidekick?
Cool. Well, thank you very much for having me, David. Yeah, so my whole career has pretty much been in fintech. For about 4 years, for my sins, I was a consultant straight out of university. But back in 2012, joined the fintech space. So I ran growth for a company called OnTrees, which was very, very early in the PFM space before we all realized that it's not a particularly exciting or interesting space. But
Yeah,
learned
it's like catnip to people who are first time founders, I think.
completely.
Yeah.
And the amazing thing is how many other people still haven't learned that lesson and are still going at it, which is like,
Oh, 100%, 100%. There is like a dogmatic refusal to learn that lesson.
yeah. We learned that lesson and we learned it 15 years ago, believe it or not, or 14 years ago. But yeah, so I ran growth for that business. I mean, it makes me sound old. I am turning 40 this year, but our whole USP at the time was banks don't even have apps. So how would you get a good experience on top of your banking products? So yeah, ran that business. Well, I didn't run it, but ran it as part of a small team for about a year. I was an early employee. I wasn't one of the founders, but we ended up getting an exit to Money Supermarket in 2014. Me, kind of bright-eyed, bushy-tailed in my 20s, thought, well, that was easy. You just kind of build a business, someone buys it in a year. It's all good. I want a bit of that. 2014, I set up a company called Parity. So that was the first time I was a proper founder. And again, it was broadly in the open banking space, but we had quite a different hypothesis. We saw that if you were able to source bank transactional data, cash flow data, that there was a hypothesis that you could more effectively underwrite near prime thin file clients than using a traditional credit score. And this was when Wonga was killing the world, basically. So it felt a very pressing issue to go and solve, of try and help people who were not great at accessing credit to access much fairer rates rather than have to turn to predatory lenders. So yeah, so ran that business for 4 years. It was a nearly not quite business. Like I'd still stand by the fact that it's a good thesis. You see a lot of the banks today using that type of approach, but just completely wrong timing. And if startups are one thing, it is about luck and timing. So we did get an exit. So we sold that business in 2018 to Tandem Bank. It was, it was not a life-changing outcome, but it was, taught me a lot through that journey. Very briefly then, spent a couple of years at Tandem. I was chief product officer there. So really saw the inner workings of a bank, which was great. We were, I'm sure lots of similar war stories, David, of getting a bank off the ground and learning and finding your feet and all that stuff it's probably the hardest task you could possibly tackle in fintech. And was pretty proud of seeing that from the inside, but finished my earn out there. And yeah, I then masqueraded as a VC for a couple of years. So, I'd strongly believe you should only work on things you deeply care about and are hugely passionate about. And at that time, there wasn't like a burning business problem I really wanted to solve, but I thought I've got a lot of scars from all of that.
Mm.
So, founders like other founders, don't they? And isn't there a space for more of an operator investor space? So yeah, so I moved
The
into.
answer is there's always more room for operator investors.
Yes, I couldn't agree more. I would say when I joined VC, the market was in a different state, though. At the time, I don't think anyone gave a shit, to be perfectly honest. It was COVID, valuations were booming.
Yeah.
all the good companies. It was just money was being thrown left, right, and center. It was more about how quickly could you give a term sheet and how much could you pay at the time, rather than necessarily like what a great operator you might be, and and I'd love to have you on my cap table. But that's the story for another day. But or potentially not. But yeah, did a couple of years in VC and saw a big opportunity that that has now become Sidekick. So I can get into lots of detail on that, but yeah, left after 2 years, and now I'm 4 years into the Sidekick journey, and no regrets. We are on the right path.
Let's start with that, like that sort of day zero thing, right? So, you are, no, I wouldn't be so unfair as to say sort of kicking your heels up at this VC, but you have a day job. Um, what happens? Like, what's the catalyst? Like, what makes you wake up and go, aha, like this is the thing that I just it's borrowed. Because for me, it's like, and I think this is true for a lot of founders, that like the the idea, the kernel, the company, like it just gets under their skin in a way that they just like can't stop thinking
Right.
about. So like, what happened to make that happen for you?
So, like, not to bash on VC at all, but it is it is a luxury job. Like, it is a great job. It is a great job because you can kind of intellectualize a space. You can think thesis. You can think macro. You can think all of these things. And what was really evident, I've been spending a lot of time on the wealth space, looking at democratization of private markets and alternative asset classes and all this stuff. What was blindingly obvious was that there was this big macro shift that was happening at the time, which was, you know, previous generations had built their wealth through property historically. The millennials, of which I'm proudly part of, we were all bashed for spending too much money on avocados and not ever able
Still
to
mad about this, by the way. Still super mad about this.
hell out of me. But we were kind of maturing through in the sense that like we were starting to get into that growth accumulation stage of our life, and there was this massive generational wealth shift that's been happening and is happening at the moment of boomers transferring property wealth across, of us reaching that kind of prime professional level, starting to actually earn decent salaries. Um, and money was moving at an unprecedented rate. So, with a VC hat on, you're kind of thinking there's something interesting going on here from a macro perspective. Money is moving in an unprecedented way. Who's capturing it, et cetera, et cetera. But more importantly, then, I always think massive businesses get built when there's a huge macro trend that collides with a big tech leap forward. And the big tech leap forward at the time was AI was nascent, clearly, but there was blockchain that was happening at the time. There was fractionalization, tokenization, all of this stuff going on that was meaning that money and the rails was changing. Basically, it was now cheaper, faster, easier than ever to move money around, to break stuff up, to open things up. And the combination of those two factors felt like something really, really interesting was going on. So with a VC hat, I was digging into that space a lot. And we made an investment into a company called Drive Wealth, who are infrastructure providers. They provide custody and execution, work with massive providers like Revolut, do fractional stock trading basically. And just caught that wave. So made an investment when they were at the Series A, and the business just boomed. Um, so we're sitting on the board at the time, just seeing this absolute Goliath on fire, basically in a good way. Like it was growing ridiculously. So definitely felt like, okay, there's a big tech breakthrough here that's enabling amazing things. There's this big macro trend that's happening. But then these two things don't make sense because me, my friends, the people I know, my peers are all complaining about the fact that there's literally nothing out there to go and solve their pain points and their problems. How can any of that be true? So it was gnawing away at me that there wasn't an obvious solve. My starting point was I'm an investor. I should be trying to find a business that is solving this problem where I have a big thesis on. And there just wasn't. So yeah, so I left not with a clear, let's go and build this business, but a clear, like, there's something going on here. There are some nascent factors that I think need to be kicked and need to be looked into in more detail. And I'm an operator at heart. I feel like I'm the right one to go and at least try and figure out if there is something here.
So we're 4 years in. You've got a product up and running in market. How would you kind of describe the position that you've taken today?
hmm So position now, so that very loose, very woolly, there's something going on was 4 years ago. What became really, really, really clear really quickly was there's this huge gulf. So if you've got £1 million plus, you're okay. You go to a private wealth manager, an IFA, even a private bank at the lower end of that.
Taking
Uh,
notes here for my future wealth.
yeah.
Yes. As a completely broke ass founder to be Matt Ford notes on how to manage my wealth.
Well, I haven't got to the kicker of why you shouldn't be doing that. But yeah, you're kind of okay. It's very well served. There are a huge number of advantages that come with that. Wealth creation is largely about allocation, but it is also about risk management. You know, it's all of that good stuff. And you've got experts there helping you navigate this incredibly complex process and basically piecing together all the tools that are available out there to go and maximize that outcome. You could probably call that a private, like broadly private wealth, private banking. Right at the bottom end of the spectrum, though, it's also really well served. So there are the robo-advisors who are all helping you put your first £500 into an investment portfolio. There's all the round up your spare change providers that are helping you get started. There's all these easy access savings accounts that can help you get going with a pound. Like fintech has done a phenomenal job there. But there's this massive white space in the middle for hardworking professionals who are on a six-figure salary. So well, for all intents and purposes, doing pretty well. You know, they might have 250,000, 500,000 of assets. So again, doing pretty well, but they're essentially treated like an entry level investor. They are not interesting enough yet for a private bank, but their needs are a lot more complicated than those entry level products. And the only way that they can figure this out is all on their own. And they're kind of piecing it all together, but feeling completely out of control of it. And also, they're just busy professionals who've got better things to be doing than spending all the time researching how they should allocate and how they should spread their wealth. So, that opportunity really crystallized pretty clearly, which is there is a segment opportunity for people who money is now very serious. They're in the growth accumulation stage of their life. They're underserved and they need something more sophisticated than entry level, but more digitized, open, and accessible than a traditional private bank. So we're not a bank. We work with providers like such as yourself who are banks, but we think of ourselves as private banking opened up for the mass affluent audience ultimately.
So I really agree with you about that kind of like the market space of that kind of first step on the ladder is like hyper well served at this point. Um, and as someone who does not yet have £1 million plus and does not have a private banker, um, what do things look like as you start to layer in like the next level, right? So like what is Sidekick doing that goes beyond what you can get from, whatever, like your kind of starter accounts at the other providers?
Yeah. So we have four pillars broadly to what we do. First is cash management. So some of that is not entry level, but relatively vanilla savings account because there is always a need for a savings account to manage your short term liquidity. We provide a good rate on that. We work with good banking partners on that. Great. Um, we start to then elevate that though. And for instance, we have a product called MultiShield, which enables you to maximize more FSCS protection because it's actually three banks stacked together so that you create a waterfall between those banks. So if you've just sold a house, had an inheritance, you've got £360,000 to put to work, you would ordinarily have to do the work spreading all of that around. You can actually just have that in one account and have the waterfall managed for you. So within cash management, there's, as I say, like some basic products and some slightly more elevated products. We also go beyond just pure banking savings products. So we have an actively managed money market product called Smart Cash that we manage in house. We are a regulated discretionary manager, so we have the permissions to manage all of that. So that's the first pillar, cash management. So that is short term liquidity, get the best yield on your short term cash. Second pillar is long-term investments. And long-term investments is partly about keeping costs down on your core portfolio. Nothing particularly new there. So we provide low-cost trackers and all that good stuff. But more importantly, the way that we've constructed our portfolio means we can do hyper-personalization. So if you're, to use an extreme example, a Meta employee, you might not want any more exposure to Meta, but Magnificent Seven go and buy the S&P 500, you're still pretty exposed to that employer. So we actually construct portfolios that enable you to do the S&P 499 as an example and take Meta out of that index. So starting to enable people to really personalize what they do. And again, we as we're a discretionary manager, we're also able to run our own portfolios. So we do more defensive portfolios. Like we have one called All Weather, for instance, that is intentionally designed to behave defensively but more resiliently through different market conditions. So that's really all about, like, for your core, keep fees down. Fees are the enemy, go track the markets, great. But once you've got that core in place, then start to personalize and tailor it and manage some of that exposure that you might have. So those are the first two pillars: cash management, public markets. Third pillar is where we really start to differentiate, which is private markets. So public markets, great on their own, but private markets can play a really great diversifier. So for slightly more sophisticated, more affluent clients, we offer access to LTAFs. So we have a global private equity LTAF as an example, which means you can access a private equity product, but just from £10,000, and that has like a degree of liquidity in there as well. And we're going to be rolling out lots more in this space as well. So we're looking at everything from like angel investment networks and VCTs and a variety of different things. And then lastly, like fourth pillar is what we call wealth services. So that is some of that like higher touch, more kind of irregular use case type products that really, that's where the private banks and premium wealth managers start to set themselves apart. So we do Lombard lending as an example, and we're the only ones we're aware of that are regulated under consumer credit to do Lombard lending for without using any exemptions. So customers can borrow against their investment portfolio if they have a liquidity need, rather than having to sell their positions, which could create a tax liability and things like that. So those are kind of the four fundamental pillars. That's very much like the product shelf, and private wealth is not just about products, it's about service. So the layer that wraps all over the top of that is much more of a white glove, much more of a high touch. And we're going to be expanding into things like relationship managers and financial planning. And eventually we may even get to financial advice, but that's not, not something that we do today.
What's been the hardest part of building all of this?
I mean, the footprint, I would say, like the complexity of the footprint. Because I think about fintech from 15 years ago, you did, I mean, to be fair, a feature. Like they weren't even businesses really, they were features. And you did one thing really well, which is typically how I would tell any founder to build a business: pick a very small, pick a big problem, but a small part of it, and solve it extremely well before you start expanding into other stuff. That world doesn't really exist in fintech anymore, because a lot of those shop pain points have all been solved with point solution. And particularly when you look at wealth is not I just need to reduce my FX, or I just need to be able to get access to one particular thing. It's a much more holistic piece.
Yeah, it really is a platform play at an individual level, really.
Completely. So just this pure ground we had to cover so early to build savings, investments, public markets, private markets, lending with scarce resources, early stage funding, complex regulation, all of that stuff. And I think, like, I look back now, I'm like, we've done way too much. But I don't know what like the path to get there would have been otherwise, because otherwise you would have been this very small solution that just never earned the right to play in a wealth game ultimately.
Yeah, I mean, I think we obviously went on a very similar journey, in the sense that like the early conversations we had with investors were basically like, well, your proposal is to do this thing that is wildly capital intensive, is going to take you years and years to do, has significant regulatory risk, blah, blah, blah. Why don't you just go and get an EMI license or what have you? And I was like, because that is a mature field. You know what I mean? Like if I do that, then the thing that I have built is no better, and in fact worse than what is already in the market. Like I cannot achieve market penetration or market entry that way. The only way I can achieve market entry is by having, like, paying this huge upfront cost, but then on the back of it having this kind of like highly differentiated proposition. And that by itself is just day one, right? Like, so I suppose like next question from here is like, okay, cool. So you've invested all of this time and effort, and I'm sure heartache and sleepless nights in just getting to where you are. Like, where do you want to take this, right? Like now that you've got it, like what comes next?
I mean, scale is everything. To not answer your question and jump back, but actually just what you said before that, like, does chime a huge amount of like, well, why would you start at the easy point? Because then it's a crowded place.
Oh yeah, 100%. And like this also, by the way, I mean, and this is like the lovely thing about working in fintech is like obviously like AI, like it's all amazing, blah, 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 blah. But like you look around and there are like immensely valuable software businesses that are just being completely blown up like a week later because someone has figured out how to use AI to build something that is functionally equivalent or at least as good, but with one new trick, right?
Right.
Like whereas the merit and also the pain of this like approach that you and I have, which is very kind of regulation forward and infrastructure forward, is like no, it turns out I'm completely immune to that, right?
Mhm.
Like someone else would also have to be willing to cut a pound of flesh out of their body in order to catch up to me. And
And
like there's no
find real
shortcuts they
failure.
can take, right?
Yeah. No, completely. And like, it's a blessing and a curse because like raising money means it is one of the most painful experiences every single time we go out to raise money because it means 99.9% of people are like, well, I'd rather do that simpler thing over there that's popping and is on fire and I can point at some metrics already. I mean, but when you get it over the line, like, it means that you are in a bit of white space because there are not others that are capitalized like you need to be capitalized to be able to go and do it. So the reason I kind of said that is because like where we're going next is all part of that because robo advice failed largely as an industry because what they realized was that they ended up tackling the wrong segment. They tackled people who didn't have enough money ultimately with the wrong
Mm,
product, which was a commoditized 60/40 portfolio that ultimately meant that there were too many people running at it, which meant that there was price pressure, which meant that you just needed this Goliath scale to ever be able to get there.
yeah. Yeah.
And like Wealthfront is a good example. They were kind of the early ones in the US. They've had a successful IPO and it's all finally got there, but it's hundreds and hundreds of millions in 15 years to be able to get there. Well, a whole hypothesis, and I even had a slide in our pre-seed deck of like why you shouldn't invest in us because
I do love so it's funny. Do you know Perry at Augmentum by any chance?
yeah,
Yeah, so I was catching up with Perry recently in the context of our raise, and he was like, "Let me tell you," he's like, "This might be a contrarian view, but I think you should open your pitch deck by telling people what sucks about your business and why it's a contrarian investment and why like everyone else is going to pass." And he's like, "And then you could pitch them on the actual thing." And I was like, "I don't know, man. I mean, like like I sort of get it, but
had it as the last slide if that's any comfort, not the first. I think the first is pretty punchy, but like basically that, which is like if you're not interested in long term, if you're not interested in consumer, if you're not interested in all these, this is the wrong thing for you. But this is why it is so different. That if you can actually get to the people who actually have money, and you are getting people who give you 100,000, 200,000, 300,000 pounds rather than 2,000, 3,000, then all those things that 100 VCs will tell me every week of CAC's going to be too high. It's going to be a couple of £100. How do you make that scale? If you get the right customers, you're fine. So number one, we got to make sure that we have a brand, make sure that we have positioning, make sure that we get trust with the real segment, not just the easy quick wins at the bottom who will never be worth anything. The second is you need a diverse enough kind of business model monetization strategy that you are not just trying to skim little bips off the bottom. So today we have a large amount of cash. There's not a viable business for us on our own to just be building cash. Like we have to believe that more personalized investments can command a higher take rate, that some of those wealth services like Lombard lending and financial planning and things like that, which are a lot
I mean,
less.
as your banking partner, I hope that you continue to acquire as much cash as possible. But
Well, you'd be the ones making more money from it than us, but yeah, but as in, you need billions and billions and billions of just pure cash if you're just doing cash. Where you need to believe that there is a business model that is putting together lots of different streams to be able to ultimately drive take rate up. And for us, like a wealth front or something like that is commanding 20, 30 bips, traditional robo-advisors. We need to get north of 75 bips really for this space to happen, for this business model to work. So that is a big priority. So scale up amongst the right segment, not just anybody. So that is not millions of clients, that's tens of thousands of clients. Get the business model right. So really make sure that we're diversifying, pulling in those higher take rate products, getting the right mix right. And the combination of those two, then all of a sudden, all those things that people were scared about, which was your CAC's going to be way too high, they all disappear. So that's what we've got to prove out over this next 2 years until we have to go and raise money again.
Yeah, I mean, it's again, we're very different businesses, but it's not that far off from us. Where, like, there is in fact a CAC number that is wrong, but like you're going after very, very high value customers, and we're going after essentially enterprise value customers a lot of the time. And so the reality is, like, our CAC is almost irrelevant because we're like super positive net revenue retention, like very, very long-term relationships, very, very low churn, right? Like, and so like, ultimately, right, like, on a long enough time frame, the kind of value of each individual customer is essentially infinite. Like, and then you just have to slice that down into kind of like, well, what do I need my payback period to be, just like from a business perspective? But it's not like a business that is operating on thin margins with high turnover, right? Like, these are incredibly sticky relationships. Wealth is a relationship that lasts like decades, right?
Completely. And kind of the third factor, apart from just right audience and right business model, you're completely right. Payback is everything. So I think like the biggest thing that we're really shifting on is there's no shortcuts to trust, but like, what are the shortcuts to trust? Like, how can you get people to bring in more money onto the platform earlier in their journey? And what are some of those product sets or trust signals or whatever it may be to try and do that? Because like, there's some really great businesses that have eventually been built 15 years later, but they look like terrible businesses for about the first 11 years, and they've eventually come good just because of compounding, where we don't have that luxury. And I think if we can prove that we can get up that hurdle faster, and you will have seen as our banking partner, I mean, like, we've started to get some pretty chunky initial deposits.
I mean, I look at our MI on a daily basis. I literally, so there's like a couple things that I get. So I get like platform wide, what has happened in the last 24 hours. And then in my particular case, we're in the midst of rolling out a product with Uber. So I go and look at the Uber metrics very specifically. And then I get like a dump of customer level shifts and metrics, like, again, on a daily basis. And yes, I'm very pleased with the positive tracking of the Sidekick portfolio. I mean, we've really only just started quite recently, right?
Yeah,
So
literally a few weeks ago. Yeah, a few weeks ago.
And I mean, obviously, I was trying to get you in the door from day zero. What finally got you over the edge? Because I don't think I was really the one who actually kind of ended up holding your hand through that process. Like, what was the thing that made you really finally go, all right, like, the time has come, like, let's do it?
I mean, you'll tell me I'm wrong and that you were ready a long time ago. But if I reflect on 3 years ago, probably three and a half, it must have been about 3 years ago that we wrote our regulatory
In
application.
fairness, three years ago, we did not have a bank license, so
Yeah.
that is that
Yeah.
yes, that would be a reasonable reason not to have chosen us at that time.
There wasn't a lot of choice. There were two players in town really at that point that had an EMI license that had got enough experience that we thought were credible partners to put in front of the FCA. One of them then had a few blips, so we ended up going with
It turned out to be less credible, perhaps.
Yeah, exactly. So yeah, so it was a small game. It was a small pool at the time. It was always a constraint running on e-money. I think we always had an ambition to get to others. But I mean, I would say this, David, like, the market's been waiting for what you've been building. So
Oh, thank you. Thanks, buddy. I mean, it's very nice. Like, we the thing that we've built is so fucking hard to build that there wasn't a lot of competition when we started, and there still isn't a lot of competition now that we're here. And yeah, that seems to be working kind of reasonably well for us. Coming back to you guys. So, talking a little, I mean, we talked about CAC earlier, but like, um, how do you acquire customers right now? Like, I mean, and you don't have to spill any sort of super secret sauce, but like, there are rich millennial gatherings, but I have to assume that you don't go to rich millennial gatherings and hand out, I don't know, branded cocktails to acquire these people. Like, how are you actually, breaking through the noise and kind of getting in front of people?
Yeah, I mean, maybe we should go to the rich millennial gatherings. It's definitely
I
how
think I
some.
think basically you just need to like go through the like Soho House like membership.
Not sure how many of them actually got any money anymore, but yeah. But no, I mean, more than 50% of our users come organically, so that's something we've been proud of from day one. That
And what does organically look like? I mean, does that mean that their buddy is like a Sidekick customer? Like, how do they first hear about you?
a bit of search as an avenue, particularly with our MultiShield product. There is a lot of people going, "What do I do? How do I
How
spread?"
do I diversify across banks?
Yeah,
Yeah, but I love that product, by the way. It's something that's like there's a bunch of analogs to it in the US, but there's like a real kind of open space in the UK for that.
completely. So yeah, I mean, there's definitely kind of search-led stuff. Lombard lending is another example where we see there's just not a lot out there. People looking for that
Yeah.
type of stuff. Um,
And sorry, and are you? And I'm sorry, I'm partly asking completely selfishly,
no,
but is that with the Lombard lending that you're doing? Is that principally against assets that are held on the Sidekick platform, or is
has
that
to be. It has to
it
be.
has to be? Yeah, okay, because you have to be able to take ownership of the asset
Yeah,
to take it as security. Yeah, that makes
yeah,
sense.
completely. So there's a little bit of that. There's a little
So
bit of
rats, I cannot in fact get a loan from you for my Griffin shares today.
not today. I mean,
Not today.
no, maybe if you put it in a Vanguard tracker or something, that'd be different. But anyway, one day, one day. Um, but yeah, so there's a little bit of search intent because we do have slightly more esoteric products for in certain use cases. Word of mouth has proved pretty effective for us. But we use this analogy of a house with many doors. So we know that a wealth relationship is built over time. But actually, you need to bring people in to solve a today problem, not a tomorrow problem, which has always been the catch-22 with wealth, that like it's always just a thing I'll solve tomorrow. There's never been that burning platform. So we really do a lot of like product sell. So, right now is ISA season, surprise, surprise. You know,
Hmm.
pretty competitive at the moment, but there's real
Yeah,
demand for this stuff. So sell
yeah.
that single product. But then if you have enough breadth on your shelf that you can then start to move them from single product into multi-product. Um, Sometimes we dangle a really good rate. That's another way that we do it on the savings product, for instance. So it's a bit of a mix. But we're about to spend some proper money. I mean, we are putting together quite a big campaign at the moment to get the
Boy,
yeah.
I'll be watching.
It's all relative. I mean,
Yeah.
but for us, it's going to be the first time that we properly shout fairly loudly, which is going to be exciting.
And then, I mean, where does all this fit into like some of the larger like political conversations that are going on around, um, like I mean, pensions generally, but then B also, like does the average UK person save enough? Like, and do you get like political engagement on this, or is that like not really kind of a priority for you just at the moment?
Um, I mean, it depends what you mean by political. I mean, I think the biggest surprise probably I've had is related to a lot of like the political stuff that's going on, which is just there is so much more risk aversion in the UK around
Mm,
me than I ever thought. And there's always a danger of being in your own echo chamber and you know hanging around too many people that do angel investments and have got excess cash and assume that there's many, 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 many more in that position. Um, but the risk, I mean, we are still, and I mentioned it at the beginning, we're still in a world where property is the number one asset of choice for people who get any money. And it's seen safe as houses. It's seen like it's a very tax efficient way as well of building wealth if it is your primary residence. But property is number one, and then just safety and security is the other. And I think that's what's surprised us most, is just that perhaps the hunger for some of the more racy, risky, push into private markets, do all of this type of stuff. It takes a huge amount of time.
Mm,
So, like, I see where the government is coming from, which is like, if you're earning 3.5% on a bank account and inflation's running high and wealth is eroding and there's no path to bridging that, and people are not putting enough into pensions and people are not thinking long term enough or not taking enough risk, there's carrots and there's sticks. And, and I do think, like, if you look at some of the biggest societal changes we've had, like stopping smoking, like that was a pretty big stick, to be honest.
mm.
And sometimes those types of things work and are necessary to kind of really force proper cultural change. In money, it's quite harder. Tax is often the biggest stick, if you like. Uh,
Yeah, yeah, 100%. I mean, I do think, I mean, the one thing that always just stands out to me is completely insane is that we have a stamp duty on like domestic share purchases. I'm like, that's nuts, right? Like, and uh, it is really interesting to me because I think, there is a serious need in this country for us to shift towards more risk capital if we want to see the growth that that I think everybody like wants to see, right? Um, and distribution vehicles for risk capital are fundamentally linked to like education, right? And like bringing people on that journey that actually, the high yield cash account may seem really safe and it's safe like this year, but it's actually not safe on like a 30-year run basis. And it's extremely unsafe when you look at it through the lens of like the UK as a country trying to like manage its sovereignty, basically.
100%, 100%. But it is such a challenge. It is so ingrained and it is so embedded. So, I know it was controversial about slashing the cash ISA limit and all those types of things. Like, I think, to be honest, like that in itself is not going to solve this much, 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 much bigger issue. And I know there's a big
I think it's
campaign.
a huge start, though. I mean, I had to, I mean, again, I have to be careful what I say on social media, but like I was pretty tempted to say like, look, I think this is good for the country, really, like objectively, because in spite of the fact that like stuff like the cash ISA limit should favor me, like does favor me, like as a bank or me, us, Griffin, right, like economically. At the same time, like it really rubs me the wrong way that the banks and building societies fought so hard against it because I'm like, this is not like in the interest of the country, right?
I mean, I'm with you in that camp, and I know what you mean, because I had multiple LinkedIn posts drafted at various points, thinking, like I'm actually gonna. It was an emotional moment, I think, for about a
Yeah.
month, but you also kind of, there's a lot of people defending vested interests, and the most vocal were just happened to be Bitcoin ISA providers. But I don't think that on its own is gonna solve everything at all. I think there has to
No,
be
no, I agree.
it
Yeah.
even has to be more radical. I mean, like a marketing campaign about why investing is good is not going to do anything. Like,
No, I mean, I mean, in many ways, I think something like Revolut is actually the greatest incentivizer, right? Because it like FOMO, as you will know, as someone who has sat on the other side of the table for a little while, right? Like FOMO is an incredibly powerful way to get people to change some behavior,
mhm.
right? And looking at something like that and the kind of investment returns that people have had, and be like, look, like I'm like obviously not everything is going to be a Revolut investment, but like Jesus, but like like that is what you are leaving out of consideration when you say I'm just going to put it in property or in a savings account is the possibility that you, yes, even as a retail investor could get like a 100x 1000x return, right? Like and like there's a whole range of asset classes that you can get into that are on the one end like obviously extraordinarily high risk and you have to have a really high risk appetite and risk tolerance for that, to things that are going to get you like a considerably better return than 3.5% but are more risky than putting it in a bank, right?
Yeah, yeah. It's just like, I get it though. Like fear of loss is all back to behavioral economics and everything, loss aversion and everything. All of that stuff is. stuff that fintechs have been fighting for years. Banks, like everyone has been fighting this stuff for years. So, but I do think it's going to take something just a lot more radical than where we are today. And culture, it does take a long time unless you
Mm.
take more radical steps to really shift things. So, I'd definitely be a proponent of more radical solutions. I don't know what that is. I mean, maybe I'm kind of spitballing, but maybe like I don't know, insure the loss on the first £1,000 that anybody puts into a low cost tracker rather than like write it off as tax, just like you know, government robs of the loss. Don't know. But like something to get people going and
Mm.
show like education is one thing, but also just learning by doing is the other. And I think familiarity that this stuff isn't scary, familiarity with you know, the literature around it is important. But
Yeah, I mean, we've talked about, or not we, but there's been a lot of talk about financial literacy as like one of the biggest misses, right, in like UK society, and it's linked to the risk appetite, right? It's like people are afraid of what they don't understand, and they don't understand it because they've never been taught, right? Like there's the conversation just doesn't happen. Cool. We're sort of coming to the end, so we'll get into whatever like fun random questions. If you were going to do it all over again, what do you wish you had known on day one that you learned that might have led you to do things differently?
um not to like repeat the conversation we had, but it is probably the most accurate one, which is just the like, don't start at the risky end of the spectrum. Like if I look at our original
Mm.
launch
Uh-huh.
products, I had a really strong hypothesis, which was you are never going to earn the trust of someone as a year one, year two startup for the
Hmm.
core of their money. So play at the more at the periphery with more esoteric products, and then
I see. Sort
over
of like be that like you're like find that weird thing because they're least likely to have a point solution for the weird thing and be the point solution for that rather than come into like a little
and
bit more mass
yeah,
market.
and then pull them into the core.
Yeah.
I do think that was a mistake, honestly. And you know, if you look at
Mm.
our product rollout, we went from much racier stuff at the beginning, and actually we kind of retrenched back to more kind of secure, safe, still a very innovative products. But so I think that was probably the biggest thing. I don't think we wasted money because those products will come good, but I think we just got
Yeah.
the ordering wrong, which is
Yeah. It ends up having a very big effect on like go to market. Yeah, it's interesting. I think we had we had like an inadvertent similar thing, I think, where, you know, like when we launched on day zero, like the primary accounts that we expected that were like fundamental to the business plan were like safeguarding and client money. And those are still things that we sell all the time, but they are slightly more challenging to sell, and the timing is a real issue for the customer you talk to. Like they have to be at a very specific point in their life cycle. Whereas the two things that have ended up being transformational for us have been embedded savings and essentially like embedded current accounts, where we're like, these are things that you can layer in that you may not have today. And so like the conversation is almost always germane. Like we can always have the conversation. It might still be like a not now, but it's not like one of these things where it's like, oh, well, I'm already set up with blah, blah, blah. So like come back in like 5 years. Cool. And then, when you think about this year, like what is going to land this year that you're super pumped about that you want to tell people like, hey, if you become a Sidekick customer today, let me tell you like what you're going to get like by the end of 26.
a lot more. A lot more. Having just done all the road mapping for the year, it feels like a 3-year roadmap. But yeah, there's a lot. So broadly expanding asset classes, instruments, variety of stuff that we're doing on the public market side, expanding out that private market side. I think there's some really, really interesting stuff and questions that we need to answer as a business around the financial planning layer. And I think that's the area that I'm intellectually most interested in because there is, you know, it's easy just to say throw AI at the problem. Like maybe not for this segment. I mean, you can automate some of it, but it's then very easy to say, okay, we'll just throw a financial advisor at the problem. But again, there's a reason the financial advice industry is a cottage industry. It hasn't been scaled, it hasn't been disrupted by tech. But I do think there is a really, really important question to be had around how do you help going back to that risk aversion, going back to all of those things. If the answer is, well, because of the cognitive load, because of the complexity, like people just do need support with the decision making process. Like, what does that look like for an aspiring mass affluent that isn't some grey haired old man in Surrey that's charging you 1.5% fees for
Yeah.
one time advice? Yeah.
Yeah. Yeah. Yeah. It's super hard. Like as you, like the first question is how do you hack trust, right? As a new entrant. And then the second question is how do you scale trust?
If you have a
Super
secret,
cool.
David, I am all ears.
Yeah. No, man, I don't, I don't have the answer to that one, I'm afraid. Look, super grateful for having you on. It's always good to have a little chin wag. Obviously, more grateful even to have you as a customer than just as a guest on the podcast. Please continue to say nice things about us to anybody who might possibly be looking for a banking partner. And think that's our show.
Cool.
Thank you, Matt.
Thanks for having me.